You've probably heard that an account-based pension is 100% tax-free, and for most people it is. But there's a $2 million limit built into that deal, and if you accidentally go over it, the ATO will charge you tax on the excess every single year. Not a one-off penalty, an ongoing annual tax bill on money you already thought was safe. So the question isn't just, should I set up an account-based pension? The question is, how do I set it up without tripping over a rule that almost no one warns you about? In this video, I'll walk you through exactly how the transfer balance cap works, why the standard advice to move everything into pension phase can actually backfire, and the one strategy that gives you more flexibility and a lower tax bill at the same time. I'll also show you how your account-based pension interacts with your age pension, because those two things are more connected than most people realize. If you're between 55 and 65, and you're starting to think seriously about how your super pays you an income, this is the video to watch before you make any decisions. And if this kind of practical retirement planning is useful to you, hit subscribe now. I put out a new video every week that covers real numbers, real rules, and real trade-offs. No fluff, no products to sell. Let's start with the transfer balance cap. From the 1st of July 2025, the maximum amount you can move into pension phase, the tax-free side of your super, is $2 million. That's the cap. Full stop. While your super sits in the accumulation phase, the fund pays tax on earnings at up to 15%. Once you move money into an account-based pension, those earnings become tax-free. That's the whole reason everyone talks about pension phase. It's a genuine tax advantage, but only up to $2 million. Now, what happens if you go over? Say you transfer $2.2 million. That extra $200,000 is called an excess transfer balance. The ATO calculates notional earnings on that excess, currently at 15% of the earnings. On a $200,000 excess earning 6%, that's around $1,800 a year in additional tax every year, until you remove the excess and bring yourself back under the cap. This isn't the ATO trying to catch you out. It's a rule designed to keep the tax-free benefit proportionate. But if no one sits down and explains it to you, it's very easy to walk straight into it, especially if you've had good super growth and your balance jumped in the last few years. The cap is indexed to CPI in $100,000 increments, so it will likely move again sometime around 2027. But for right now, $2 million is the number. ASFA's retirement standard suggests a couple needs around $70,000 a year for a comfortable retirement in Australia. The $2 million cap is broadly sized to support that level of spending, which means if your balance is noticeably above $2 million, you're in a different conversation about how to structure things, so you know the cap exists. But here's the part that surprises most people. You don't actually have to move all your super into pension phase. In fact, keeping some in accumulation might work out better. Let me show you why. I used to think the obvious move was to shift every dollar into pension phase the moment you could. Maximum tax-free earnings. Simple. But after watching people hit the cap and end up worse off than they expected, I changed my mind. Sometimes the smartest tax strategy is to not maximize the tax-free account. Here's how the split strategy works in practice. Let's say you have $2.4 million in super. You move exactly $2 million into your account-based pension, the full cap, and you leave $400,000 sitting in accumulation. The $400,000 in accumulation earns 6%, which is $24,000 a year. Tax at 15% on that is $3,600. That's the cost of keeping it there. But here's what you get in return. That $400,000 is not subject to minimum drawdown rules. You don't have to touch it. You can let it grow. Over 10 years, at 6%, that $400,000 grows to around $716,000, while your account-based pension is paying you income and gradually drawing down. The result is more total money over the long run, a clear buffer for unexpected expenses, and no risk of breaching the cap. The $3,600 a year in tax on the accumulation portion is the price of that flexibility. For most people, it's worth paying. If you're under 65, there's also a transition to retirement pension, which lets you access some super while you're still working and keep the rest in accumulation. That's a topic for another video, but it's worth knowing it exists. The bigger point here is that the split strategy is a trade-off, not a trick. You're accepting a small tax cost in exchange for flexibility, a buffer, and protection against cap breaches. And the more your super has grown, the more relevant that trade-off becomes. Now, the split strategy only makes sense if you know your exact cap headroom. But there's another layer most people don't think about: what your account-based pension does to your age pension. That interaction can easily be worth more, or cost more, than anything else we've discussed so far. Here's the trade-off most people don't see until it's too late. When you put money into an account-based pension, that full balance counts towards Centrelink's assets test. Every dollar. And depending on where your total assets land, that can reduce or completely cut off your age pension entitlement. As of March 2026, the maximum age pension for a single person is around $1,144 per fortnight, which is about $29,744 a year. For a homeowner couple, the full pension cuts out at $451,500 in assets, and the part pension disappears entirely at $1,031,000. Those are Centrelink figures from Services Australia. So if you have $2 million in an account-based pension, you're well above those thresholds. You get nothing from Centrelink. That's fine if your super generates enough income, but it's worth being clear-eyed about it. Now consider this: if you kept $500,000 in accumulation and moved only $1.5 million into your account-based pension, your total assessable assets drop. Depending on your other assets, that might bring you into range for a part-age pension. Even a partial entitlement, say $300 a fortnight, adds $7,800 a year to your income. That's not nothing over a 20-year retirement. The second trade-off is about what happens when markets fall. If all $2 million is in an account-based pension and the market drops 20%, your balance drops to $1.6 million. But you still have a minimum drawdown requirement: 4% under age 65, 5% between 65 and 74. At $1.6 million, that's $64,000 to $80,000 you're required to take out, which means you're selling assets when they're down. If you have $500,000 in accumulation as a buffer, you have options. You can draw from there during a downturn, give the account-based pension time to recover, and avoid locking in losses by selling at the bottom. The trade-off is real. A larger account-based pension gives you more tax-free income. A smaller one might preserve some age pension and gives you more flexibility in a downturn. Neither is automatically right. But here's the part that keeps people up at night. What happens when you need a lump sum for something urgent? Imagine you're 68, single, and your account-based pension balance is $800,000. The roof on your house needs replacing. The quote comes in at $50,000, so you withdraw it as a lump sum from your account-based pension. Your balance drops to $750,000. The minimum drawdown at age 68 is 5%. So next year, instead of drawing $40,000 as income, you're drawing $37,500. That's a permanent $2,500 drop in your annual income from a single decision that felt completely reasonable at the time. Major home repairs in Australia, roofs, hot water systems, structural issues, typically run anywhere from $15,000 to $50,000. These aren't rare events, And if you're drawing down your account-based pension as your primary income source, a lump sum withdrawal has an ongoing cost that most people never calculate. The unprepared version of this looks like: see the bill, withdraw from the account-based pension, move on. No one told them about the income drag. The prepared version looks different. You keep $20,000 to $30,000 in a separate savings account outside super, a proper emergency fund. When the roof bill comes, you use the savings account first. If the total repair costs more than your fund covers, you take a smaller amount from the account-based pension to top up. You also check whether a large withdrawal would temporarily push you over a Centrelink threshold and affect your entitlements. It's not a complicated plan, but you need to have it set up before the bill arrives, not after. Now you might be thinking, I'll avoid all this by just leaving my super in accumulation. It seems safer. No drawdown rules, no forced withdrawals. But that thinking has a real cost, and it's the one that quietly surprises people most. A lot of retirees hate the idea of forced minimum drawdowns. The logic goes, if I keep my super in accumulation, I decide when I take money out. No one can tell me what to do with my own savings. I understand that. It feels like control. But the actual cost of staying in accumulation is 15% tax on every dollar of earnings every year. If your $800,000 earns 6%, that's $48,000 in earnings, and $7,200 goes to tax. In an account-based pension, that same $48,000 is completely tax-free. I've been through this calculation myself. When I turned 60, I kept putting off moving to pension phase because I didn't want to lock in a drawdown commitment. It felt like I was giving something up. But when I actually ran the numbers, I was losing around $6,000 a year in tax I didn't need to pay. Over 5 years, that's $30,000 gone. The minimum drawdown in an account-based pension isn't a restriction on your freedom. It's a tax-free income floor. If you need $50,000 a year and your minimum drawdown is $40,000, you only need to source $10,000 from somewhere else. The rest arrives tax-free. Compare that to accumulation, where every dollar of growth is taxed before it ever reaches you. Loss aversion is real. No one wants to feel like they're being forced into a spending schedule. But focusing on the discomfort of mandatory withdrawals while ignoring a 15% annual tax bill is a very expensive way to feel in control. So for most people, pension phase wins. But there's one more thing almost nobody thinks about when they set up their account-based pension. What happens to it when they die? When you set up an account-based pension, one of the most important decisions you make, and one of the most commonly skipped, is your beneficiary nomination. Specifically, whether you have a binding death benefit nomination in place. Without a binding nomination, when you die, the fund trustee decides who gets your money. That process can take time. It can create family conflict, and it can result in a tax outcome that nobody planned for. A binding nomination removes that uncertainty. Now, who you nominate matters, because super death benefits are taxed differently depending on the relationship. If your beneficiary is a dependent, your spouse, a child under 18, or someone financially dependent on you, they receive the account-based pension, proceeds tax-free, no tax on the way through. If your beneficiary is a non-dependent, most commonly an adult child over 18, they pay tax on the taxable component of your super. That can be up to 17%, including the Medicare levy. If you've been making concessional contributions your entire working life, there's a good chance a large portion of your super is the taxable component. So your adult children could face a meaningful tax bill on an inheritance they assumed was tax-free. One strategy to reduce that is what's called a recontribution. You withdraw a lump sum and recontribute it as non-concessional money after tax, which changes the composition of your super. That can reduce the tax your beneficiaries pay. But you need to watch the transfer balance cap. If you're already at $2 million in pension phase, recontributing changes the structure, not the cap. And there's one more thing worth knowing if you're married. If you die and your spouse wants to roll your account-based pension into their own pension, they can, but only if they have room under their own transfer balance cap. If their cap is already full, they'll need to take the money as a lump sum instead, which changes the tax outcome. So you've seen the trap, the strategy, the Centrelink interaction, and the estate planning piece. Let me pull it all together. Let me bring this together. The transfer balance cap is $2 million from the 1st of July 2025. Exceed it, and the ATO will tax the earnings on your excess every year until you fix it. That's the hard rule. Inside that rule, the split strategy gives you a practical way to use your super efficiently. Move exactly what you need into pension phase. Keep the rest in accumulation as a buffer. You'll pay 15% tax on the accumulation earnings, but you get flexibility, a lower cap risk, and potentially some age pension you wouldn't otherwise qualify for. Your account-based pension balance counts in full under Centrelink's assets test. That's not a reason to avoid pension phase. It's a reason to be deliberate about how much you move. And always keep a cash buffer outside super for unexpected expenses. So a roof replacement or a car repair doesn't permanently reduce your income floor. Finally, check your binding death benefit nomination. Make sure it's current, make sure it reflects what you actually want, and make sure the people who matter to you understand the tax implications of what they'll receive. You don't need to get every one of these decisions perfect. Getting 80% of this right, knowing the cap, thinking through the split, keeping a buffer, updating your nomination, can save you tens of thousands in tax and protect your age pension over a retirement that could last 25 or 30 years. If this kind of practical, no-fluff retirement planning is useful to you, please subscribe. I release a new video every week focused on helping Australians keep more of their super and retire with confidence. Thanks for watching. I'll see you in the next one.